Well, uh, we're going to now swivel a little away to a discussion around portfolio construction, attribution, and risk return optimization. Again, my name is Sidhartha Dash, or Sid Dash from Chartis Research, and I'm going to run this panel today with, and I have with me three panelists who are experts in this area, and we're going to talk a little bit about some of the themes, expanded view of some of the themes that we just discussed before. That is the key challenges of building and managing portfolio construction, attribution, risk return models, valuation, etc., in a universe of massively expanded set of securities and tools that can be used in this investment process. With that, I would like to welcome my fellow panelists and have them introduce themselves. So, Lou, could you introduce yourself?
Good morning again, everyone. This is Chang. Thank you for having me here today. I currently serve as the Chief Risk Officer at a New York-based hedge fund by the name Axonic Capital. Basically spent the past 10 years in a small boutique asset manager focusing on structured credits such as RMBS, CMBS, CLOs, and ABS. And prior to that, I was at the sell side at Wells Fargo, as well as Legacy Wachovia Securities, serving in similar roles.
Thank you. And now that we can finally hear you, Joyce, could you introduce yourself?
Yeah, hello, good morning, everyone. Thank you for inviting me to this panel discussion. So I'm Joyce Chen, and I'm the Director of Investment Risk Research at Investment Management Corporation of Ontario. So we have approximately 70 billion asset to manage for the provincial government. And we have two founding clients, Ontario Pension Board and Workers' Safety Insurance Board. So we manage a multi-asset class portfolio, and my team is mostly responsible to heavily involved with all the new transaction risk assessment across the entire private markets in private credit, private equity, infrastructure, and private real estate, like to assess the risk characteristic of all the new transactions as we sort of build out the private market allocation in the past few years. So really looking forward to have the discussion with the panelists here.
Thank you. Now, Sam?
Yeah, so my name is Sam Rubendas. I'm focused on, my team focuses on modeling, assets for risk management and asset allocation framework, including private assets. We work with a number of pension plans, sovereign wealths, in modeling private assets and helping integrate that into the overall risk management framework.
Thank you. It's been a little more challenging to get our systems moving, but nevertheless now we are all in place and we all can hear each other. So hopefully let's dive in. So with that, I want, if you will, our focus today as it is how does the whole art of modeling, valuation, portfolio construction, risk attribution, risk management, and whole portfolio optimization, how do these sciences and arts change as we start expanding into private assets and private credit and so on? We recognize that those assets and private credit is an increasingly large segment of the overarching asset ecosystem. But let's dive in and understand from these experts how the art and science of portfolio management is changing. So with that, I would like to ask, in your view, what are the challenges of integrating private credit, structured credit into portfolios? Lou, could you start with that?
Absolutely. So the structured credit or private credit is a very, very attractive asset class, especially in the previous years where the interest rate is so low. So it's a perfect carry product that have a enhanced income component as well as uncorrelated feature from any other major asset classes. So this makes it very, very attractive. Nevertheless, talking about the challenges, I like to highlight three major challenges in my view, especially from where I sit in the private structured credit shop. So the first one is truly the lack of data. Whether you're trying to allocate to this space or trying to conduct a risk management task of this asset class, the lack of data is very, very pronounced. Most of the shops who are running this type of asset classes or treating this type of asset classes primarily count on their proprietary data that is accumulated through years of trading in the market. A third party can have some of the agency data or some of the generic data, but when it comes to idiosyncratic data for private credit, it is a biggest challenge in my view. And the second one that I want to touch base on, the previous presenter also highlighted is the liquidity. This is not the most liquid asset in the world. It is somewhat opaque. It's primarily traded over the counter. So you will see at the normal market, people may argue, well, it's liquid because the moment I put my asset on the market, it's trading. And that is absolutely a true statement. But at the time of crisis, the liquidity status of those bonds can deteriorate very fast. When everybody just suddenly stops trading, the liquidity dries up very fast. And the third one I want to highlight is truly the assessment of the credit quality. When it comes to structured credit and private credit, assessing that credit risk is the key and truly is the most difficult task to carry out by any risk managers or PMs. From a third-party point of view, usually people like to count on credit rating, but it's not super helpful when it comes to this asset class. For instance, when you see a bond that is not rated, right, people usually equate that to a junk bond or low credit quality. But it's not necessarily the case for a structured credit because sometimes the non-rating was just because the issuer was very small and did not being having credit rating being a worthwhile effort or worth the resources. So they decided to put it on the market and rate it. The industry practitioner will understand it because they will dig into the bond at the deep level, at the bond level. But most people will not understand it. So that is the third challenge I want to highlight.
Absolutely, those are key macro issues. But now, Joyce, are these? How do you see the key challenges? Do you would you reflect the? Would you care to elaborate there?
Yeah, thanks a lot. So yeah, I can agree with Lou more. So like during our company has a big direct lending program which started to build up since the beginning of last year, just because of there was a very strong demand on the private credit in the market, and we see the spread of the first lien senior secure loan and the second lien. And these days, like we see a lot of PIK, which provide like attractive return, and also the diversification of these particular private credit against the rest of the portfolio. So that's why like we heavily build up our practice in the direct lending program and also the private credit space in the past year. And the key challenge that we see, like most of the challenge, is the credit risk. So what we normally do, like during the underwriting process, alongside the deal team, is we are trying to assess the credit risk, how to incorporate the credit risk into our risk modeling, because most of the risk system only capture the market risk. So how do we incorporate the credit risk? So we leverage the Moody's risk count to particularly look at the fundamentals of the private like borrowers that we are looking at. So just because we are participating in the syndication, so we have access to the fundamental and the financial statement of the borrower. So we will assess the fundamentals and trying to assess the probability of default and loss given default and assess the quality of the collateral, trying to help us to assess like what's the risk of the default and in case of the default happens and how much loss we can potentially incur. So this is one of the challenge. So incorporating the credit risk into the market risk. And then another one is the liquidity premium. So when we do the modeling, like we see the term sheet and we see the credit spread, but there is a large component of the liquidity premium incorporated in all these like private credit. So what is the right liquidity premium we should consider when we do the modeling to be able to assign the proper credit rating, because most of the private credit, we cannot find the credit rating in the public market space. So to be able to incorporate the liquidity premium into our internal corporate, like internal credit rating mechanism to allow us to properly capture the risk of the private credit is another challenge. And again, like data, we also have challenges with data as well. But then for us, we tend to rely on the GP to provide us data during the underwriting process.
Okay, understood. Now, taking a slightly different perspective, Sam, for the same question, Sam, how do you, given your background as sort of software developer, vendor, if you will, how do you and a developer of portfolio software, how do you see this sort of incorporating this asset class into portfolios, into analytics, etc.?
Yeah, look, I think this is a fairly challenging problem right now. And because the growth in this segment has been astronomical, 5, 7, 10 times in different segments, depending on how you slice it in the last few times, it is a very attractive segment, invested by both asset managers. BlackRock recently acquired, big pension plans are committing more capital to it. So at one level, there is a lot of demand for all the reasons that were mentioned in this yield environment. But the challenge really, there are a few challenges here. One, how does a investor, let's say a pension plan, like for example, we have Joyce on the call as well. How does a investor decide what percentage to allocate to private credit relative to something else? Okay. And this decision is not an easy one. There is some correlation effect with the data long enough for someone who's a long-term investor willing to ride multiple cycles. How do they make the decision today? Are you going to opportunistically do it? Is there systematic data? That decision is not a trivial one, and right now it is opportunistic. The second question you ask yourself is what is the split between a market and a specific asset? This split is something that is essential to reward managers for your decision on what to invest, where to invest. Are you going to find broadly, specifically? That question is also not fully answered right now. And then this intermingling of risks, which in the public credit space is much more linearly defined and different people look at it, which is interest rate, spread risk, credit risk, liquidity risk. It's a divided problem. Whereas when you look at private credit, it's all sitting in one place. So premium you pay for liquidity, the premium you pay for the fact that it's credit risk, you understand it much better than other people. There are very few hands that this asset goes to. All of this make this a complex problem. And right now, when you observe clients doing this, it's a little bit more art than science. Whereas you can very cleanly ask someone, why are you investing 5% in high yield debt in financials? They'll give you a very clear answer about possible spread changes, possible rate changes, expected default, and they'll be able to linearly explain why they take the decision. Ask them, why you 5% on credit? Most likely you say it's a growing sector, it's got the yield. So you're not going to get that very granular response on the back of that. So it's a challenge, and I think it's more art now than science. Reminds me a lot, maybe 10, 15 years ago, when how you invested in private equity. Before that, even in equities long time back. So it's a little bit of an evolution and maturity that we need to see in data and decision making.
Okay, I think that highlights some of the key challenges as you sort of try to bring private credit into the same universe and the same sphere as rest of the assets. I'd like to ask Lou specifically to start with. You highlighted some of the challenges around data and liquidity. How do you bring that into the valuation framework? How do you bring the characteristics of private and structured credit into the valuation framework? How do you ensure that you can value these securities, with reasonable certainty and structure, given the characteristics that you've just outlined, if you will?
This is really a very important consideration when it comes to private credit, right? Because when people think about valuation, most people are very used to thinking of valuation as a very accurate point. But when it comes to credit, it's actually a small range, right? So different market practitioners have a different view on a particular bond, and they can be both right? They could be 3 points apart. Some people value a bond at 97, some people value it at 100. And there's really no clear view who is right, who is wrong. They can be both right, depending on how market moves. So long story short, the best valuations can be provided by none other but the portfolio managers who actually comb through their bonds day in, day out and stay on top of the market. However, the market does not want the portfolio manager to do that because they are incentivized to keep the valuation as high as possible. With that said, the holy grail of valuation really is you have to enlist a third-party valuation provider. And the challenge there is it is very difficult for them to have the specialty and the depth of knowledge of that particular bond and also stay on the market because they don't trade. So that introduced a practice called price challenge, right? So when the valuator provided the valuation, the PM has the opportunity to challenge it using market color or their model assumption, and then there is a conversation going on. This is a very healthy mechanism for the valuation to be as accurate as possible. Because on one end, we benefit from the PM's view. On the other end, we benefit from an objectivity of a third party who is not incentivized to keep the valuation as high as possible. Now, with this mechanism in place, some of the structured credit shops decided to introduce mutual fund, which has daily liquidity. So this, again, caused a whole set of valuation considerations, especially from the operational point of view, right? Because mutual fund NAV struck every day. The challenge has to really happen very swiftly, very timely, before 6 p.m. usually. That is when the NAV struck, to ensure that you are not going to make a mistake in your NAV, because that is a big deal when it comes to mutual fund. You do not want to get into the practice of restating your NAV. So from where I sit, I have personally designed a process to, with a fixed 15 minutes interval, making sure the administrator, the PMs, the valuation team all work in tandem to ensure that this process works very well.
Well, thank you. That highlights some of the sort of idiosyncratic and interesting and sector-specific nature of the valuation. In some ways, as Lou highlighted, it's probably a conversation, and as Sam pointed out, a little bit of an art and science element, if you will. Joyce, how do you react to what just Lou said just now?
Yeah, so we don't do valuation in my team because we mostly work alongside with the deal team to underwrite the deals. So what we tend to be asked by the investment committee is for the spread that we are getting for each of the private credit, like the loan that we are lending, and are we being compensated the right like price? So this is the question that we need to answer. So what we tend to do is we come up, as I mentioned, like we have a Moody's risk out to help us to do an internal credit rating, and then we tend to reference the credit rating that we get from our risk count, and also reference against the credit spread that we get from the deal. And also we look at the going to the market database to look at those public traded bank loans and see by each sector or region what are the general kind of spread that we observe for a certain credit rating that fits within the deal that we are looking at. So we compare the spread, trying to answer the question like whether we are being compensated with the right risk premium.
Thank you. Sam, from your perspective, again, taking the sort of vendor's lens, how do you see the valuation challenges given lack of data, opacity, and the whole challenge process that sort of Lou outlined, if you will?
Yeah, so for us, given the investment and the focus that the large investors have, and the data is more or less one-to-one. If you look at every other asset class, you have one dominant vendor who has collected all the data. We liaise with them, wrap it with a valuation model, wrap it with a risk model, and then we work that way. In the case of private credit, so far, it's been a very one-to-one relationship. Every client gives the data, and we sort of work around that, and we provide the data, very much sort of, one-to-one. And I think that makes it challenging. It makes it sort of very difficult from that standpoint. We are working on it. Everybody's kind of trying to aggregate it, but that's sort of the big challenge. The data is one of the biggest challenges. The model is all of that can be built, once you have a collected source of data as opposed to more distributed avenues.
Okay. And so as we enter into the sort of, the home stretch of our discussion today, within the whole sort of private credit universe, I mean, there's obviously many different types of assets, many different types of many sectoral differences. Would you highlight any specific sector that sort of stands out in its complexity or structure, or would you highlight some key differences between the different sectors, if you will, Lou?
Yes, since I'm deep in the woods with this type of asset classes, each and every one carries a completely different set of features, credit risk, and market factors. So I would say there is a pretty noticeable difference between all structured credit products from where I sit, even though they are all called structured credit. For instance, aviation ABS specialist is very highly unlikely that the same PM will be able to cover a commercial real estate structured credit, right? These are just very, very different product. So, in the past decade, what I see is each team is specifically focusing on the sector that they are specialized in. And when it comes to valuation, as we just discussed, the modeler on the valuation team needs to be highly specialized as well. So long story short, you just really have to look into each sector separately. You can't put all structured credit into the same bucket and think, oh, I'm going to put money in this bucket of assets. It is the best that you converse with the specialists to understand them.
Thank you. Now, clearly this, as Lou highlighted, this is an incredibly varied and diverse sector. And, we could continue this discussion quite forever, if you will, literally. We could dive into details of individual sectors. We could dive into individual modeling issues, etc. But I think key themes have been brought out by the panelists, if you will. variability, diversity, challenges in data, and liquidity, all of which results in substantial differences in valuation frameworks, substantial challenges in portfolio models, which, as Sam highlighted, is a bit of an art and a science. So with this, I bring today's conversation to a close. Hopefully, it highlighted some key issues in a rapidly emerging and growing and challenging sector. With that, thank you, Lou. Thank you, Joyce. And thank you, Sam.
Thank you.